Have you ever, dreamed of creating those passive income streams? You know, the kind that could eventually replace your day job? But maybe you felt completely intimidated because of this myth that you need, I don't know, a massive trust fund or some closely guarded insider secret to start.
Yeah, it's really treated like this exclusive club.
Yeah.
Like there's a towering financial cover charge just to get in the door.
Exactly. But what if the only thing standing between you and a massive property portfolio was just, well, a disciplined grip on your own monthly budget and maybe this capital recycling strategy known as BRRR?
I mean, it completely flips the script.
Yeah.
The barrier to entry isn't necessarily having millions of dollars. It's really just a lack of structural understanding.
Yeah.
People just assume the heavy hitters are using brute financial force,
Right.
when in reality they are using highly methodical, totally repeatable systems.
Which is exactly what we are stripping down today. Our mission today is to basically extract the ultimate blueprint for building wealth through real estate from that video. From getting your very first property to building a massive portfolio, proving that it is way more accessible than most people realize. Okay, let's unpack this.
Well, to start, we actually have to look away from real estate entirely.
Wait, really?
Yeah, the video makes a point that catches a lot of eager investors off guard. Before you analyze a single market or look at a single property, you have to audit your own wallet.
Huh.
The author argues that your personal finances are basically the inescapable bedrock of your investment career.
I mean, I see the logic there, but it feels a bit like, eating your vegetables before you get to the dessert. If you've saved up a decent down payment, why does a lender care if you bought a little too much on your credit card last month?
Well, because lenders don't just look at the cash you bring to the closing table. They heavily scrutinize your debt-to-income ratio, your credit history, all of it to gauge your risk profile.
Oh, to see if you're actually reliable.
Exactly. A high credit score unlocks fundamentally better loan terms. And over the course of a 30-year mortgage, a 1 or 2% difference in an interest rate doesn't just mean, a few extra dollars a month.
Right, it compounds.
It translates to tens of thousands of dollars in lost profit. So aggressively minimizing your high-interest consumer debt before you invest isn't just good practice. It directly dictates the profitability of your future deals.
Wow, okay. And the video also hammers really hard on building a personal emergency fund. I think the temptation for a lot of people is to just scrape together every last penny they have, drain their savings entirely, and throw it all into that first down payment.
Oh yeah, people do that all the time.
But if your car transmission blows out or you get hit with a huge medical bill and all your cash is trapped inside the drywall of a rental property, you are incredibly vulnerable.
You're totally stuck.
You might be forced to liquidate that asset at a terrible price just to cover your personal life.
Yeah, that cash buffer is your armor. And once that armor is in place, you can safely leverage what the author calls the 4 wealth generators.
Okay, I know we're familiar with the basic concepts here, like cash flow.
Right, the monthly rent left over after expenses.
Yeah, and appreciation, where the property's market value historically just kind of climbs over time. But the other two are where the math gets incredibly tilted in the investor's favor.
Oh, absolutely.
You're talking about loan pay down and tax advantages. That's essentially having a magic savings account. You buy an asset with a loan, but you aren't the one paying it back. Your tenant goes to work every day to slowly eliminate your debt, effectively buying the house for you over 30 years.
And brilliant.
But I do have to push back on the rosy picture here just a bit. Isn't it incredibly risky to assume a tenant will always be there, reliably handing over rent? What happens when a global event hits or a local factory shuts down and that property sits empty for 4 months?
I mean, you're right. That is the nightmare scenario for an over-leveraged investor. Vacancies are an absolute certainty in this business. But what's fascinating here is how these 4 wealth generators actually act in synergy to mitigate that specific risk over a long time horizon.
Wait, how do they do that?
Well, they aren't isolated mechanics. They work as this multi-layered net to create long-term stability rather than just a get-rich-quick scheme.
But if nobody is paying rent, the cash flow drops to zero. The net breaks, doesn't it?
The cash flow drops, yes. But while the property sits vacant, it is still likely appreciating in the background. And more importantly, you are still legally capturing the tax advantages.
The tax advantages, even with no rent coming in?
Yeah. The IRS allows real estate investors to claim something called depreciation. Basically, they assume the physical structure of your building is slowly breaking down over 27.5 years.
Okay.
So they let you deduct a portion of the property's value from your taxable income every single year.
Oh, wow.
This is what's called a phantom expense. You didn't actually spend that money out of pocket, but it legally shields your other income from taxes. So even in a bad month for cash flow, the asset is still structurally building your wealth on the back end.
That phantom expense concept is wild. I mean, if the underlying math is so heavily weighted in the investor's favor through, tax codes and tenant-funded debt payoff, why isn't everyone succeeding? What separates a rock-solid portfolio from just being a complete money pit?
It comes down to a really defined strategy and market selection. If we connect this to the bigger picture, you can't just throw a dart at a map or hunt for the absolute lowest price per square foot. The video specifically warns against the trap of cheap real estate.
Right. There's always that temptation to go online, find like a $40,000 single-family house in some random town, and instantly become a landlord.
Exactly.
Yeah.
But you have to ask, why is it $40,000? Usually it's because the area is bleeding population or the local economy is just resting on a single pillar.
Like a single factory or something.
Yeah, imagine buying a dirt-cheap duplex in a town where 60% of the population works at one specific manufacturing plant. If that plant relocates overseas, your tenant pool vanishes overnight. You now own a worthless liability in a ghost town.
So you're basically looking for diverse economic vital signs. It's like checking the health of the city. You don't just want job growth. You want job growth spread across tech, healthcare, education, manufacturing.
Right. It's essentially an insurance policy against a localized recession.
Makes sense.
Right.
And the Bookwatch summary also emphasizes that you have to pair that healthy market with an understanding of your specific tenant demographic.
Yeah, you really have to know who you are renting to. Are you buying a Class A condo downtown for young professionals? Or maybe a 3-bedroom house in a good school district for a growing family.
So the property type has to match people moving there.
Seamlessly.
Yeah.
A beautifully renovated 4-bedroom house is totally useless if it's placed right next to a university where students only want cheap individual leases in multifamily apartments.
Okay, so let's say we found that golden market. The vital signs are perfect. The demographic is clear. We found a property that fits the mold. The numbers look good on paper. But, acquiring real estate still requires massive capital, right?
Usually, yes.
Tying up $50,000 in a traditional 20% down payment every time you want to buy a house, it just doesn't sound very scalable. How do investors actually fund these deals without locking up all their liquid cash?
Well, they step outside the traditional banking system. While standard loans and FHA loans definitely have their place, the video really highlights creative financing.
Like what?
You have hard money lenders. These are private companies that lend based on the value of the asset itself rather than your personal W-2 income.
Oh, interesting.
Yeah, they do charge much higher interest rates, but they move incredibly fast to fund a distressed property purchase.
And the video also brings up seller financing, which honestly always sounds a bit counterintuitive to me. Like, why would a seller willingly act as the bank? Aren't they just taking on the massive risk of me defaulting instead of getting a clean break with a lump sum of cash?
You really have to look at the seller's motivation. That's the core of any real estate negotiation. Imagine an older landlord who has owned a property for 30 years. They're tired of fixing plunging toilets, and they just want to retire.
Okay, fair enough.
If they sell that fully paid off property for cash, the government is going to hit them with a brutal capital gains tax bill all at once.
Ah, I see.
But if they offer you seller financing, they get a steady, passive monthly check from you. So they're acting as the bank without having to actually manage the property.
Right.
And because they are receiving the money in installments, they spread out their tax liability over years.
So you solve their tax problem and their management fatigue.
Exactly. And in return, you acquire an asset without needing a bank's approval. It's purely a strategic alignment of interests. You don't show all your cards or maximum budget too soon. You just build rapport and find out what they need.
That fundamentally changes how you view a negotiation. It's not about grinding them down to the lowest purchase price. It's about playing detective to figure out what pain point they're actually trying to solve.
Precisely.
But here's where it gets really interesting. Turner outlines this very specific, aggressive capital recycling strategy, the BRRR method. BRRR. Buy, rehab, rent, refinance, repeat.
It is the absolute engine of rapid portfolio growth.
Yeah.
It solves that exact problem you mentioned earlier about running out of down payment cash.
Let's actually walk through the mechanics of this because it sounds almost too good to be true. It's literally like recycling your initial capital. So
Right.
you buy a distressed property under market value, right? Maybe a fixer-upper using short-term cash from a hard money lender.
Yep. Let's say you buy it for $100,000.
Okay, $100,000. Then you put, say, $30,000 work into it. New kitchen, new floors, that's the rehab.
Right. So you are all in for $130,000.
Got it. Next, you place a great tenant in it. That's the rent phase. Your cash flow is live.
And then comes the crucial step, refinance. Because you force the value of the property up with that $30,000 rehab, the house might now appraise for, let's say, $200,000.
Right. Wait, but if you refinance, you just have a bigger loan. How are you actually making money if your debt just increased?
Well, here's how it works. You go to a traditional bank, and they offer a cash-out refinance at, say, 75% of the new appraised value.
Okay.
75% of $200,000 is $150,000. The bank hands you a check for $150,000.
Oh, wow.
You take that money, you pay off your original $130,000 hard money loan, and you still have $20,000 left over.
Plus you still own the house.
Exactly. And the increased rent from the rehab covers the new, larger mortgage.
That is amazing.
Yeah, you have extracted your original capital, completely paid off your short-term debt, and effectively acquired a cash-flowing asset for $0 out of pocket.
Yeah.
Furthermore, the IRS views that $150,000 you pulled out as debt, not income.
So it's tax-free.
Completely tax-free cash. You then take that recycled capital and repeat the process on house number 2.
It's literally the velocity of money in action. You aren't saving up a new down payment from your day job. You're artificially creating the down payment out of the equity of the previous deal.
It's a game changer.
So you've gamed the system, you've recycled your capital, and you own the building. But buildings don't pay rent. Humans do.
Right.
And humans are infinitely more complicated than a BRRRR spreadsheet.
Let's talk about management, because this is where the fantasy of passive income usually hits a brick wall.
It really is the reality check of the industry. The video outlines this stark fork in the road. You either do it yourself or you hire a professional property manager.
Right. If you DIY, you get to keep all the cash flow. But you are the one taking the 2 a.m. call about a shattered window. You're the one navigating the emotional and legal nightmare of an eviction.
Yeah, which sounds awful. And a property manager typically takes somewhere between, 8 to 12% of the monthly rental income?
Yeah, usually around there.
So what does this all mean for the bottom line? Is surrendering 10% of your revenue basically just an anti-headache tax for the investor, or is it a strategic operational expense?
I think anti-headache tax captures the feeling perfectly, but it's fundamentally a strategic lever. This raises an important question regarding how you value your own time.
What do you mean?
Well, if you spend 15 hours a month driving to your property, screening applicants, fixing appliances, all just to save $200 in management fees, you are effectively paying yourself a little over $13 an hour to be a maintenance worker.
When you could be using those 15 hours to analyze new markets, network with private lenders, and actually find your next BRRR deal.
Exactly. The highest and best use of an investor's time is finding capital and finding deals, not snaking a drain. Plus, a manager is crucial for long-distance investing and scalability.
And a good property manager also acts as a legal shield, right? The video is pretty uncompromising on the legal pitfalls.
Oh, absolutely. Real estate is heavily regulated. You cannot ignore the laws. If you improperly screen a tenant and violate fair housing laws, or if you try to cut corners on a formal eviction process, the resulting lawsuit will wipe out years of your profits.
You also have to form an LLC to protect your personal assets, get proper insurance, all of that.
Right. A professional manager already knows the local municipal codes inside and out. Underestimating legalities is the fastest way to fail.
Which brings up a critical distinction the author makes about expenses. It's a story we hear all the time with novices. They run their spreadsheet, they account for the mortgage, taxes, insurance, and maybe a 5% buffer for routine maintenance, like, a leaky faucet or a broken blind.
Yeah.
And the cash flow looks great, but they completely ignore CapEx, capital expenditures.
Ah, the silent portfolio killer.
Right, because routine maintenance is cheap. But a roof has a lifespan. An HVAC system has a lifespan. A novice investor might enjoy $300 a month in positive cash flow for 2 years, thinking they are a total genius, and then the HVAC system blows out.
And suddenly they have to write a $6,000 check.
Exactly. Because they didn't properly reserve a portion of their rent for CapEx every single month, that one system failure completely wipes out their entire 2 years of profit.
It really highlights why you have to treat this as a clinical business entity. The video specifically warns against getting emotionally attached to the property.
It's hard not to, though.
It is, but it is not your home. It is a box that generates revenue. You must run it based on rigid math and legal compliance, not gut feelings.
Okay, so let's say you've navigated the CapEx traps. You've placed a good tenant, you've set clear expectations and a strong lease, or you hired a manager to do it for you. You survive your first few rentals. You're actually making real cash flow. That is a massive psychological milestone. But to achieve that ultimate financial freedom mentioned at the start of our deep dive, the kind that replaces a day job, you have to transition from being a scrappy solo landlord to being a real estate business owner. So how do you scale up without just buying yourself a second incredibly stressful full-time job?
You transition from managing properties to managing systems. The video emphasizes that scale requires standard operating procedures, SOPs.
Right.
When a tenant moves out, you shouldn't be wondering what to do next. You should trigger a predefined sequence. Like the contractor's automatically scheduled for a walkthrough on day 1, the cleaners arrive on day 3, and the automated marketing goes live on day 4. You automate the rent collection, everything.
It's basically like moving from being a solo baker covered in flour in your home kitchen to running a massive automated bakery. You aren't mixing the dough yourself anymore. You are managing the supply chain and the team.
Exactly. Working smarter, not harder. And that team is critical. You need rock-solid contractors, a specialized real estate CPA, and investor-friendly agents.
And the video mentions scaling also requires a shift in mindset and networking, right? Because real estate requires a lot of patience and continuous education.
Yeah, you can't operate in a vacuum. Networking is a two-way street. You have to attend local meetups to find off-market deals before they ever hit the internet. You network to find private money lenders. But perhaps most importantly, you network to find mentors.
Because building a portfolio can be deeply isolating. Hearing real-life stories of how not only fumbled and seasoned investors triumphed kind of humanizes the process. It shows that investing isn't just calculations, it's a human endeavor requiring perseverance.
It really is. Your regular friends and family might not understand why you are stressing out over loan-to-value ratios on a Tuesday night. You need moral support.
But at what point do you stop scaling? Like, does it ever actually end? Or are you just doomed to be on a real estate treadmill forever, endlessly refinancing and hunting the next deal?
Well, this brings the conversation full circle back to your personal goals from the very beginning. You step off the treadmill by reverse engineering your entire operation based on your exit strategy.
Oh, okay.
You don't just accumulate properties blindly. You accumulate them to meet a specific lifestyle metric you defined way back when you audited your personal finances.
So if your goal is 10 grand a month in passive income to travel the world, once your portfolio hits that net cash flow, you just stop acquiring. You just maintain.
Exactly. Or maybe your strategy revolves around generational wealth. Real estate offers some amazing exit strategies like owner financing or lease options, but one of the most profound tools is the 1031 exchange.
What's that?
Basically, you can sell a property and roll the profits into a larger property without paying any capital gains tax. You can theoretically do this your entire life, deferring the taxes forever.
Wait, forever?
Yeah. And when you eventually pass away and leave that massive portfolio to your heirs, the tax basis of those properties is stepped up to the current market value.
Wait, really? So if you bought a building for $100,000 and it's worth $1 million when you pass away, your kids inherit it. And if they sell it the next day for $1 million, they pay zero capital gains tax on that $900,000 of growth.
Exactly. The deferred tax liability is legally wiped out upon inheritance. That is how dynasties are built.
Yeah.
Your exit strategy dictates your growth strategy. You have to know what the finish line looks like before you run the race.
That's an incredibly empowering way to view it. So just to summarize the journey you've taken with us today, it doesn't start with millions of dollars. It starts with getting your own personal finances in order.
Right.
Then you pick the right market, avoiding the trap of cheap real estate. You run the BRRRR math to recycle your capital. You survive tenant management with ruthless systems, and you scale up to financial freedom based on your exit strategy.
It is a profound mechanism for financial independence. But before we wrap up, there is one final concept to ponder that wasn't explicitly covered in the source discussion.
Oh, what's that?
Well, we've spent this entire deep dive talking about building your wealth, minimizing taxes, and passing properties down to your heirs. But consider the societal impact.
What do you mean?
As a landlord scaling a massive portfolio, you aren't just buying buildings on a monopoly board. You are actively shaping the actual communities and neighborhoods where human beings live.
That's a great point.
The quality of the housing you provide, how you treat your tenants, it directly impacts the prosperity of those areas. So as you execute this strategy, ask yourself, what kind of community architect do you want to be?
I absolutely love that. You aren't just building a portfolio, you are actively designing the environment around you. So if you are tired of staring at that desk, dreaming of passive income, you now have the map. No trust fund required, just financial discipline, ruthless systems, and a whole lot of strategic execution. Thank you so much for joining us on this deep dive, and we will catch you on the next one.